The rupee at 80 to a dollar. That's the big news, that's the big headline, and that's a headline that is worrying people asking questions. What has sent the rupee falling to such a level that it's touched 80? So what is it about 80? How is 80 different from 79.95 or 79.85? That is the question we are asking today, and why the fall of rupee is significant or not significant. Should we worry about it? Should we not worry about it? What are the pros and cons? And what do we make about all this hype and hoopla about this 80 number? I'm Y.P. Rajesh, Managing Editor at ThePrint. I have Economist Radhika Pandey from NIPFP with me. Welcome to another episode of Macro Sutra. Radhika, you've written your piece on the rupee touching the 80 level. We are recording this on Thursday evening, so it was 80.06 intraday, and then it recovered almost 20 paise to close at 79.85. So it's closed below 80, but it had crossed 80 yesterday, right?
Yeah.
So what is the psychologically significant mark here? You called it a psychologically significant mark. So like I said, what is the difference between 79.95 and 80?
Actually, there is no difference. It's just a number. But till now, the rupee was hovering between 79, 79.95, and the Reserve Bank of India was intervening to prevent the slide of the rupee. And then due to other external headwinds, it touched 80. So it created headline that, now rupee has touched 80. So it's kind of a psychologically significant mark in that respect. But otherwise, it's just a number. It's just that it's now depreciated from 79.80 to 80 rupees per dollar. Other than that, there is no other significance that it should create such a problem or such a concern.
It's nice newspaper headlines, TV channel headlines, but let's go beyond the headlines.
Yeah.
Why has it slid so much to touch 80? Because we did a rupee episode a couple of weeks back when it was again sliding after the Fed rate increases and all of that. But now it's slid further. What is causing this slide?
So basically, it is due to external headwinds and primarily due to the US monetary policy. So when the US Fed decides to aggressively hike interest rates, it will trigger a capital flight from emerging economies to the US, because the interest rate differential between the Indian asset and the US asset will narrow. And because US is a relatively safer asset, so it will trigger a flight of capital from emerging economies' assets, including India, to that of US. That's number one reason. And the other reason is that when you have such global headwinds, when you have war, when you have this condition around recession, there is a kind of risk of attitude amongst investors, which also leads to investments towards more safe haven assets. So that also leads to increase in the demand for dollar and dollar denominated assets. Now, what has triggered this slide as of now? It's due to the US inflation data for June. It was expected that US inflation data will start moderating, but the June inflation data, again a very high number of above 9%. And the day the number came out, there were expectations that now Federal Reserve will increase rate by 100 basis points. In the previous meeting, they had raised rates by 75 basis points. Now there was expectation that now it may raise by 100 basis points. So that talk of 100 basis points hike led to the US bond yields rising, and therefore increase in the demand for dollars and outflow. So it's more of dollar strengthening rather than rupee weakening.
And next week, this Fed date has been set for a rate review, which is 27th Wednesday. By the time we get to know it, it'll be Thursday morning, 28th of July. Whether it is 75 basis or 100 basis points, you fear that will further slightly affect the rupee?
So if it is a 100 basis points hike, it will affect the rupee because it will trigger a sharper, exit from the Indian markets. But if it is a 75 basis points or a 50 basis points, I think that has already been priced in by the markets, because markets move ahead, they think ahead. So that much amount of hike has already been priced in by the markets. So in fact, if the US Fed raises interest rate by 50 or 75 basis points, it will be a positive for the Indian markets. So they may see a rise. And that's what we are seeing. If you see the last 2 days, foreign investors have turned net buyers.
Yeah, even today they bought.
They bought. Yeah. So the selling intensity for the moment, at least in the initial days of July, has moderated. And the last 2-3 days, we are seeing FPIs becoming net buyers.
Yeah. So you have written that the depreciation of the Indian rupee is linked to the strengthening of the dollar index. Can you explain what this dollar index is for our viewers, Radhika?
Yes. Sure. So dollar index is an index of dollar with respect to its 6 most traded currencies. So it will tell us about the relative strengthening of the dollar against its major trading partners. So it includes euro, yen, and other currencies with which US has prominent trade. So now if other currencies depreciate, say if euro is depreciating, then the dollar will appreciate. And so dollar index is actually used as a gauge to assess the strength of the dollar. Now, what we are seeing is that because the US bond yields are rising, there is a greater demand for dollar, and therefore the dollar index is rising. Or in other words, in simple words, it just means that dollar is getting appreciated with respect to its other relative currencies, which are its major trading partners.
Radhika, I was telling you before we started recording the show that the question we asked, why, or the statement we made was not a question, that why it isn't bad news. But there is some bad news built into this because it impacts our twin deficits. How bad is that?
So if we see what's happening is that, because the prices of our imports are already rising and we are importing, so it's already affecting our current account deficit because of the war. And now if the rupee depreciates, we know that if rupee depreciates, it makes our exports cheaper and imports costlier. So that will lead to another increase in the value of imports and will pose a pressure on our current account deficit. On the other hand, a weaker currency makes our exports cheaper. So to the extent that exports become cheaper, it will help in bridging some of the deficits. So it actually depends on which of the sectors are gaining. There are some sectors who will gain from rupee weakness, like the IT sector will gain, tech sectors will gain, the services exporters will gain. But on the other hand, the goods imports, which are already rising, will increase further due to the rupee weakness. Now, it needs to be seen how far the rupee slides further. And if we look at some of the early indications, we see that the worst may be over. So we can talk about that a little bit more. But coming back to the current account deficit, so that is one channel. The other channel is that talking about the other deficit, which is fiscal deficit. Government imports fertilizers and provides at subsidized rates to farmers. So now if fertilizer prices will rise, one due to increase in the prices due to the war, and further due to rupee depreciation, it will lead to increase in fertilizer prices and government will have to provide more subsidy. So that will lead to increase that could pose a pressure on fiscal deficit. Again, on the positive side, because of higher inflation and the denominator, the GDP will increase, so that will bridge the fiscal deficit to GDP ratio. So there are contrasting factors at work, but definitely a weaker rupee is a problem for our both fiscal deficit as well as current account deficit.
And also the government is cushioning fuel prices and we are importing fuel.
We are importing
paying more
fuel.
for petrol, diesel, crude.
Yes. So we have seen that the government has slashed import duties, and already because of all those measures, fiscal deficit would increase by around 2.5 to 3 trillion rupees. So if there is further slide in the rupee, all those pressures will further aggravate.
But like you have mentioned, inflation is moderating now.
Yeah.
So crude prices have fallen. Food prices are also beginning to moderate a bit. So that is again some kind of hope for the CAD, right?
Yes. So if we look at our major importable commodities, what we are importing and what led to an increase in current account deficit. So crude oil is one. Edible oil prices is another important factor because of which we had to slash import duties on crude palm oil, refined palm oil, sunflower oil. So now if we look at the international indicator of global food prices, which is the FAO's, Food and Agricultural Organization's Food Price Index, we are seeing that the June month was the third straight month of decline in food prices, primarily due to edible oil prices. So now we are seeing that edible oil prices are declining. Metal prices are also declining, and aluminium, copper have cooled from the peak seen in the month of March. So if these commodity prices start to decline, and if we see a sustained moderation, to that extent the CAD will moderate and it won't see a very sharp surge. And if the CAD, the current account deficit, does not rise to that extent, the rupee weakness will be shielded to that extent. So that's a positive thing we are seeing, and that is getting reflected in the markets also. Markets are also thinking that inflation might have peaked. So we are seeing markets are recovering and FPIs turning net buyers.
Although some stock market gurus say this is short covering, as they call it. But that's okay. We can live with short covering. The rupee has appreciated against other major currencies like, the pound, the euro and yen. What is the significance of that? I mean, dollar is the major international currency, but appreciation against these other currencies, does it help in any way?
It helps because it tells you that, when there's a global crisis, one needs to look at a relative level because as we, discussed that it's mostly dollar getting stronger rather than rupee getting weaker. And if we compare and contrast this episode with the previous 2013 episode of Taper Tantrum, that was the time when rupee was depreciating due to domestic fundamentals, due to worsening of domestic fundamentals. So just for a contrast, at that time, between May 21st of May 2013 to end of August 2013, rupee depreciated by more than 15% in just 3 months because of FPI outflows and because we had a lot of reliance on foreign investor inflows. This time around, from the onset of the war till now, we have seen around 6.5% to 7% depreciation, which is relatively lesser as compared to some of the other advanced economies depreciation. So that means that euro has depreciated against the dollar much more than Indian currency depreciation, and therefore relatively rupee has appreciated against the euro, rupee has appreciated against the pound and also other advanced economies currency. Also, if we look at not just looking at advanced economies, but if we look at our peers, if we look at emerging economies, they're also leaving aside some of the commodity exporters like Indonesia. Now, understandably, Indonesia is a commodity exporter. So there the depreciation is much lesser as compared to the rupee. But if we look at some of the other emerging economies, their depreciation is much more than the Indian currency depreciation. So it just drives home the fact that these are mostly driven by global headwinds, mostly driven by dollar getting stronger due to the monetary policy rate hikes. Now, if the EU and if, just today ECB, the European Central Bank, has also raised its interest rate by 50 basis points. So now the euro will get stronger. So now if the euro will get stronger, dollar will get relatively weaker. So we have to see the impact of this on the rupee. So now there is going to be an interest rate defense to fight inflation, and how much the central banks raise interest rate, that will determine their currency.
This is almost like chess. You have flagged another worry, Radhika, that is 43% of our external debt will mature this year, which means we have to service this through dollars, which means outflow of dollars.
Yes.
How big a worry is that?
So it's mostly, the commercial borrowing. It's not the sovereign borrowing. But the fact that over the last 2 years, the interest rates were low, it prompted companies to do a lot of low-cost external borrowing. And if we look at the report on external debt by Reserve Bank, we see that around 43% is due for redemption this year.
This fiscal
Now, this year.
calendar.
This calendar year.
Okay.
Yeah. So now, normally it should not have been a problem. The problem is because the RBI has been intervening in the spot
market.
and forwards market to prevent the rupee slide. And we've already seen forex reserves declining by around $50 to $60 billion. So now at a time when forex reserves is declining and we also need dollars to repay, though some amount of debt will be rolled over, but there will be demand for dollars to buy the companies to repay their debt. So it will pose a challenge for Reserve Bank to manage dollars and to manage its reserves. So it's in that context that we brought this point that, there is a limit to which the Reserve Bank can keep intervening to prevent the rupee slide at a time when reserves have started declining and there are a lot of indicators. We say that reserves should cover these months of imports. So that has, so that has now come down. So beyond the point, it will become difficult. So all these things need to be taken into account while, preventing or shielding the rupee.
We talked about these capital controls being eased and how these won't have any short-term impact. These are all long-term measures. So we will take questions now from some of our viewers who have already sent us questions on various platforms. The first one will go to Twitter. We have this question from Mr. Aditya Sirikonda. Thank you, Aditya, for sending us this question. How will the fall of rupee affect the current account balance? We have sort of talked about it. Will imports become costlier? How will it affect the Indian economy? I think that's what we've sort of summarized so far. But current account balance? Yeah,
current account balance, if rupee keeps on sliding, the current account balance will become a problem. And there's already the expectation that current account deficit could rise up to $100 billion if rupee slide continues. So that is due to the fact that imports will become costlier. But at the same time, we have to see some of the offsetting impact will be due to exports becoming cheaper. We have to make our exports competitive at this point in time to see that the impact on CAD can be minimized.
Vishnu Vijay seems to have similar worries. Vishnu asks, if the rupee depreciation does not advocate any export growth due to low demand in the world market, then will it end up in a bigger balance of trade deficit, lead to internal inflation and low forex reserves, a combination of a lot of things?
Yeah, so that's true. A weaker rupee further aggravates the problem of imported inflation because as it is due to the war, our imports have increased because the prices have increased, and a weaker rupee will further increase the prices of imports. So to that extent, there will be imported inflation. Now, there have been these concerns around exports that exports might not rise to that level because of recession. But we need to see how it shapes up in the coming months, because in 2021-22, the last financial year, we did well on our exports, merchandise exports. So we should see, at least for the services sector, exports picking up, and there we do have competitiveness and there is demand. So some part of this the deficit will be bridged by more competitive services exports.
Salil Kumar, one moment, my screen, yes. Is depreciation of the rupee really that bad? It seems the main concerns are high inflation, high unemployment, slow economic growth rate. I think what the point is trying to say is that why are we making such a big deal of the rupee falling? I mean, what do you want to tell him?
Yes, same. We agree on that point that at least during this episode of rupee depreciation, it's not just purely looking at rupee crossing 80 is not a big concern because, as I said, this is primarily due to dollar strengthening, because in terms of other currencies, rupee has appreciated, and if we look at macro fundamentals, we are doing reasonably well. So compare and contrast again with the 2013 episode. At that time, our twin deficits and our CAD fiscal deficit was quite high. So that time we faced a much sharper depreciation due to foreign inflows leaving. But at this time, even though foreign investors have exited, but domestic investors have been cushioning the market, and we are not so much reliant on foreign investors leaving and rupee sliding. So one needs to get these nuances correct to make an assessment as to whether just rupee getting to 80 is a big concern.
Last question from a user who has not shared her name. Should one take advantage of the falling rupee to capture the export market? Is that something that can be done so quickly?
No, it cannot be done so quickly, but the endeavor should be that. And I think we have started making that move from the last year itself. So if we look at some of the markets in which exports are happening, particularly for commodities like tea and some of the other prominent commodities, there has been diversification of export markets. So that momentum needs to keep going to take advantage of the weaker rupee. But again, it's a combination of a number of factors. It's a combination of competitiveness, how sensitive exports are to prices. Normally, if exports are inelastic to prices, I mean, it doesn't matter that prices are falling, the demand will remain the same. Then it's hard to expect that a weaker rupee will lead to a sharp surge in exports. So there are a number of factors, but diversification of exports should definitely be an agenda, and we have seen that happening over the last few months.
So getting the nuance right is the moral of this episode. Let's not panic that the rupee has touched 80. In fact, my question to you, my own personal question to you, the last one to sum it up is, should we look at 85, or you think it's okay? It doesn't matter. 85 is not around, but even if it is around, what's the big deal?
Yeah, so again, it will all depend on how the
external
factors play out. After the 27th July meeting, it's quite clear that Fed will raise rates by 75 basis points or 100 basis points. After that, what happens? That will determine the trajectory of rupee. But as we've seen, some of the global commodity inflation is cooling. So that should help in preventing a sharper slide. I think worst is over, and whatever slide we will see will primarily be driven by the US monetary policy.
So basically, Radhika is telling us, don't worry, don't panic. This is not so bad. There are larger economic issues we should focus on and attend to. The rupee is a part of the global currency basket, and it will be dealt by market forces. So let's learn to deal with it and fix our own internal economic issues that need fixing.
Yes.
Thank you for watching this episode of Macro Sutra. We will be back next week after the Fed monetary policy announcement on Thursday, and let's see what we have to discuss on the next episode of Macro Sutra. Until then, please stay safe, have a good weekend, and do send us questions next time. We want more questions from you. Thank you.